All right, so we've got this whole stack of articles about the stock market,
Okay.
but specifically kind of a mystery surrounding one company's crazy ride and what it reveals about this hidden risk,
Okay.
even for those of you who consider yourselves seasoned investors out there.
Interesting. I'm intrigued.
Yeah.
Lay it on me.
So the main article here is from the Motley Fool
Okay.
and focuses on Nvidia, the chip-making powerhouse.
Right.
And on January 27th, they experienced a record-breaking single-day stock plunge,
Wow.
wiping out $590 billion from their market cap.
Oh, my gosh.
The biggest loss of its kind in U.S. stock market history.
Yeah.
And now, while they did partially bounce back,
Okay.
what's fascinating is how this event really kind of exposed something crucial about the current state of the market.
Okay. I'm starting to see why you called this a detective story.
Yeah.
A massive drop.
Yeah.
But it reveals something deeper.
Right.
I'm all ears.
Exactly. So here's the first clue.
Okay.
Nvidia's plunge, despite being huge EE, was strangely isolated.
Mm-hmm.
Other big tech players like Apple and Meta actually went up that day.
Wow.
Even the Dow Jones Industrial Average increased.
Huh.
So why didn't the whole market, follow Nvidia down the rabbit hole?
That is peculiar.
Yeah.
It suggests something else is at play here.
Right.
Something beyond just one company's performance.
Mm-hmm.
Could this be tied to the concept of market concentration that's been making headlines lately?
You are reading my mind. That's exactly where this deep dive is headed.
Okay.
But before we go full Sherlock Holmes on this,
Yeah.
can you break down what market concentration actually means
Sure.
for someone like me or, the person listening in right now?
Mm-hmm.
What's the significance for everyday investors?
Of course. In simple terms, market concentration refers to the phenomenon where a small number of companies hold a disproportionately large share of the overall market value.
Got it.
In the case of the S&P 500 and the Nasdaq-100, these major indexes that so many investors rely on are now heavily weighted towards a handful of mega companies, tech giants in particular.
So it's like a party where a few VIPs are taking up all the space,
Yes.
leaving less room for everyone else.
That's a good analogy.
Okay.
And the problem is,
Yeah.
if one of those VIPs stumbles,
Yeah.
the whole party can feel the impact.
Right. Okay, so back to our Nvidia mystery.
Okay.
How does this concentration factor into their dramatic drop?
Well, let's take Nvidia and Broadcom as examples.
Okay.
Together, these two companies alone caused the Nasdaq-100 to drop by 2% that day. Even though many other stocks are doing just fine,
Wow.
their sheer size and influence can create a sort of ripple effect,
Right.
dragging the index down, even if the broader market sentiment is positive.
So even if your portfolio seems diverse on the surface,
Yeah.
you might only be more exposed to just a few companies than you realize,
Right.
especially if you're investing in index funds. Right?
That's right.
It's like you think you're spreading the risk, but you're actually concentrated without realizing it.
That's the danger of market concentration. Index funds, by their very nature, track the composition of an index.
Right.
So if the index is heavily skewed towards a few companies, your investment will be too,
Okay.
regardless of how many individual stocks the fund holds.
This is where I feel that aha moment coming on.
Yeah.
Like, I always thought index funds were the go-to for diversification,
Right.
but maybe it's not that simple.
That's right.
You could have $100,000 in an S&P 500 index fund and a few thousand in Nvidia stock, thinking you're well diversified.
Yeah.
But because of Nvidia's weight in the index, you actually have significantly more exposure than you realize.
Exactly. You have to look beyond the number of holdings and delve deeper into the weighting of each company within the index.
To be clear, we're not saying the S&P 500 or index funds are bad.
Of course not.
After all, tech's dominance in these indexes is largely due to real earnings growth, not just hype.
Right.
Nvidia, for instance, has a solid track record of innovation and strong financials.
Absolutely. It's not about demonizing index funds or specific companies.
Okay.
The point is to raise awareness about this concentration risk,
Mm-hmm.
to encourage investors to be more informed and proactive about their portfolios.
So if we're not just going to blindly follow the index, what are some other options? Like, how do we navigate this new terrain of a market dominated by a few key players?
Right.
What can investors do to mitigate this risk?
There are several strategies worth considering.
Okay.
One approach is to look beyond traditional market cap weighted index funds and explore alternatives that focus on specific sectors, themes, or even factor-based investing.
Wait, hold on, back up a second.
Sure.
What's factor-based investing?
Yeah.
That sounds intriguing, but I need a quick definition before we move on.
Sure. Factor-based investing essentially involves targeting specific characteristics or factors that have historically been associated with higher returns. For example, value investing focuses on undervalued companies, while momentum investing targets stocks with strong recent price performance.
So instead of just blindly following the index, you're choosing investments based on specific criteria that align with your investment goals and risk tolerance.
Precisely.
Got it.
It's about being more strategic and selective in your approach.
Okay.
Another option to consider is actively managed funds.
Okay.
They offer the flexibility to deviate from the index and make strategic stock selections based on the manager's expertise. Of course, active management comes with higher fees.
Yeah.
So it's crucial to weigh the potential benefits against the added costs.
So more control, potentially higher returns, but also higher fees, and no guarantee of outperformance.
Exactly.
Sounds like a classic trade-off.
Exactly. The key is to carefully evaluate the track record of the fund manager, their investment philosophy, and whether their approach aligns with your own investment goals.
Okay, so we've talked about diversifying beyond traditional index funds, exploring factor-based strategies, and even considering actively managed funds. But what about the brave souls who venture into individual stock picking?
Sure.
Is that something we should be exploring in this context?
It's certainly an option.
Okay.
But it requires a significant commitment to research and due diligence. You need to thoroughly understand the business models, financial performance, and growth prospects of the companies you're considering. It's not something to be taken lightly.
So for someone like me, or many of our listeners who might not have the time to become a full-fledged stock analyst, what are some practical steps we can take to address this concentration risk?
Sure.
Where do we even begin?
A good starting point is to simply review your current portfolio holdings.
Okay.
Identify the companies and sectors that make up the largest portions of your investments. Then ask yourself whether your current exposure aligns with your risk tolerance and investment goals.
Okay.
Do you feel comfortable with the level of concentration in your portfolio?
Right.
Or do you need to make some adjustments?
So it's all about awareness first.
Yes.
Understanding what you actually own and how exposed you are to these mega companies, even indirectly, through index funds.
Exactly.
So
Once you have a clear understanding of your current exposure, you can then explore ways to diversify further or adjust your holdings to better reflect your desired risk profile.
And if we're feeling a bit overwhelmed by all this, it's probably a good idea to reach out to a financial advisor, right?
Absolutely.
Someone who can guide us through these complex decisions.
A qualified financial advisor can provide personalized guidance based on your specific circumstances, help you develop a comprehensive investment strategy, and navigate the nuances of market concentration and diversification.
So it's like having a Sherpa to guide us through the Himalayas of the market.
Exactly.
They can help us avoid the pitfalls and reach the summit of our financial goals.
Precisely. They can offer valuable insights, perspective, and support to help you make informed decisions and achieve your long-term objectives.
This deep dive has been incredibly insightful so far.
Right.
We've uncovered this hidden risk of market concentration, explored various investment strategies, and even touched on the importance of seeking professional guidance when needed.
Yes.
But we're not done yet, right?
Nope.
There's more to this story, more to explore.
You're right. We've laid the groundwork. And now it's time to dig even deeper.
Okay.
Let's explore the historical context of market concentration, examine its potential benefits, and consider its broader implications for the economy and investors alike.
Sounds like we're just getting started.
I think so.
Let's dive in.
Let's do it.
Yeah.
You mentioned the historical context of market concentration.
Yeah.
That's a great place to start.
Okay.
It's not a new phenomenon, you know?
Really?
Yeah.
I kind of assumed it was a recent development with the rise of these massive tech companies.
While the current levels of concentration are certainly notable, it's important to remember that markets have gone through cycles of concentration and fragmentation throughout history. In the late 19th and early 20th centuries, for example, we saw the emergence of giant trusts like Standard Oil and U.S. Steel, which dominated their respective industries.
The days of robber barons and monopolies.
Exactly.
So what happened? How did those concentrations break up?
Well, in many cases, government intervention played a role.
Okay.
Antitrust laws were enacted to break up monopolies and promote competition. This led to a period of greater fragmentation in the mid-20th century.
So it's like a pendulum swinging back and forth between concentration and fragmentation.
Yeah.
Interesting. But is market concentration always a bad thing?
That's a great question.
Are there any potential benefits?
And the answer is not always straightforward.
Okay.
While concentration can raise concerns about reduced competition and potential risks for investors, it can also have certain advantages.
Okay.
For instance, large companies often have the resources to invest heavily in research and development, leading to innovation and technological advancements.
So it's like a double-edged sword.
Yeah.
It can stifle competition on the one hand, but drive innovation on the other.
Exactly. Yeah. And from an investor's perspective, concentrated markets can sometimes lead to higher returns if those dominant companies continue to perform well.
Right.
Think about the FAANG stocks. Facebook, Amazon, Apple, Netflix, Google.
Yeah.
Their dominance has been a significant driver of market growth in recent years.
That's true.
Right.
But it also means that if one of those giants stumbles, the impact can be felt much more widely.
Precisely.
Okay.
The risks are also magnified in a concentrated market.
Right.
That's why it's crucial for investors to be aware of this dynamic and adjust their strategies accordingly.
Okay, so let's circle back to our listener for a moment. What should they be taking away from this discussion so far?
The key takeaway, I think, is that market concentration is a complex issue with both potential benefits and risks. It's not something to be feared, but rather something to be understood and factored into your investment decisions.
Got it.
Whether you're investing in index funds, actively managed funds, or individual stocks. It's important to be aware of how market concentration can impact your portfolio.
So knowledge is power, as they say.
That's right.
The more you understand about the market,
the
better equipped you are to navigate its complexities and make informed decisions.
Exactly.
But where can our listeners go to learn more about this? Are there any resources you'd recommend?
There are a wealth of resources available online and offline.
Okay.
Reputable financial websites like Investopedia or Morningstar can provide valuable information on market concentration, index construction, and alternative investment strategies.
What about books? Are there any authors or titles you'd suggest for someone who wants to dive deeper into this topic?
Absolutely. One book that comes to mind is The Index Revolution by Charles D. Ellis.
Okay.
It provides a comprehensive overview of the history and evolution of index funds, including their benefits and potential drawbacks in a concentrated market environment.
Great recommendation.
Yeah.
I have to check that one out myself.
Okay.
Okay, so we've talked about the history,
right,
the potential benefits and risks, and even some resources for further learning.
Yeah.
But what about the regulatory implications?
Sure.
Is anyone keeping an eye on this concentration trend?
Yeah.
Are there any concerns about potential antitrust action, like we saw with those monopolies back in the day?
That's a valid concern.
Okay.
Regulators are certainly aware of the increasing market concentration and are actively monitoring the situation. There's a growing debate about whether current antitrust laws are sufficient to address the challenges posed by today's tech giants.
So it's like a game of chess between the companies and the regulators.
Right.
Each side is making strategic moves, trying to anticipate the other's next step.
That's a good analogy.
Okay.
The outcome of this game could have significant implications for the future of the market and the economy as a whole.
Okay, so let's shift gears a bit and explore some alternative investment strategies that might help mitigate the risks associated with market concentration.
Okay.
We touched on factor-based investing earlier, but are there other approaches that investors should consider?
One strategy that's gaining popularity is investing in emerging markets.
Emerging markets?
Yes.
Like what exactly? Sure. Give me some examples.
Emerging markets typically refer to countries that are in the process of rapid economic growth and industrialization.
Okay.
These markets offer the potential for higher returns, but also come with greater volatility and risk.
So more risk, more reward.
Yeah.
That's the age-old trade-off in investing, right?
It is.
But what are some specific examples of emerging markets that investors might want to consider?
Some examples include countries like China, India, Brazil, and Mexico. These economies are experiencing significant growth and have a rapidly expanding middle class, creating opportunities for investors who are willing to take on more risk.
Okay, so emerging markets are one option.
Right.
What else? What about this thing I keep hearing about called decentralized finance?
Yeah.
Is that something we should be paying attention to?
Decentralized finance, or DeFi for short, is a rapidly evolving space that's attracting a lot of attention. It refers to financial applications built on blockchain technology, aiming to create a more open and accessible financial system.
Blockchain?
Yeah.
DeFi?
Yeah.
Okay. I'm going to need a little help unpacking these terms.
Okay.
What exactly does it mean to have a decentralized financial system?
So in traditional finance, you typically rely on intermediaries like banks or brokers to facilitate transactions.
Right.
DeFi, on the other hand, aims to eliminate these intermediaries and allow for peer-to-peer financial interactions.
So it's like cutting out the middleman.
Exactly.
That sounds pretty revolutionary.
It is.
But is it safe? Is it something the average investor should be dabbling in?
It's still a relatively new and experimental space.
Okay.
So it's important to approach it with caution. There are risks involved.
Yeah.
And it requires a certain level of technical understanding to navigate effectively.
Yeah.
But for those who are willing to learn and take on more risk, DeFi offers the potential to diversify beyond traditional markets and access a wide range of innovative financial products and services.
It sounds like we're stepping into the Wild West of finance here.
Right.
Exciting, but uncharted territory.
That's a good way to put it.
Okay.
DeFi is still in its early stages, and its future is uncertain. But it's definitely a space worth watching as it continues to evolve and potentially disrupt traditional finance.
Okay, so we've talked about emerging markets, decentralized finance.
Right.
Are there any other alternative investment strategies we should be exploring?
Sure.
What about investing in specific themes or trends, like renewable energy or artificial intelligence?
That's another excellent option.
Okay.
Thematic investing allows you to align your portfolio with your values and invest in areas that you believe will experience significant growth in the coming years.
So instead of just chasing returns, you're investing in companies and industries that are making a positive impact on the world.
Exactly. Thematic investing is becoming increasingly popular among investors who are looking for ways to generate returns while also supporting causes they care about.
That makes sense. It's about aligning your financial goals with your personal values.
It is.
So let's recap for a moment. We've covered a lot of ground here. We started by exploring the historical context of market concentration.
Right.
Then discussed its potential benefits and risks. And even delved into some alternative investment strategies like emerging markets, decentralized finance, and thematic investing.
Yes.
But what does this all mean for the person listening in right now?
That's a good question.
What are the key takeaways they should be considering?
I think the most important takeaway is that the investment landscape is constantly evolving.
Okay.
Market concentration is just one of many factors that investors need to be aware of as they make decisions about their portfolios.
Right.
It's crucial to stay informed, be adaptable, and continuously expand your knowledge of the financial world.
So it's like we're all students in a lifelong learning journey, constantly seeking new information and insights to navigate this ever-changing market.
Precisely. And as with any learning journey, it's important to ask questions, challenge assumptions, and be open to new ideas and perspectives.
Speaking of questions, I have one more for you.
Okay.
We've talked a lot about market dynamics and investment strategies.
We have.
But at the end of the day, investing is about more than just numbers and charts, right?
Absolutely.
Yeah.
Investing is about aligning your financial resources with your personal values, your goals, and your vision for the future.
Exactly.
Yeah.
It's about using your money to create a life that you love.
Right.
To support the causes you believe in and to build a legacy that matters.
Yes.
So, dear listener, as you continue your own investment journey, remember that it's not just about maximizing returns. It's about maximizing your impact, your happiness, and your fulfillment.
Beautifully said.
Yeah.
Investing is a powerful tool for personal and societal transformation.
Right.
By making conscious and informed decisions, we can shape a future that aligns with our values and aspirations.
So keep exploring.
Yes.
Keep learning and keep diving deep.
Absolutely.
Until next time, happy investing. Okay, so we've covered a ton of ground in this deep dive, from Nvidia's wild stock ride to the broader implications of market concentration.
Yeah, we have.
And even explored some alternative investment paths for those looking to chart their own course.
Absolutely.
But before we wrap up, I want to leave our listeners with one final thought-provoking question.
Okay.
Something to ponder as they continue their own investment journeys.
Right.
Given what we've learned about market concentration, are there any ways to potentially turn this knowledge into an advantage? Not just mitigating the risks,
right,
but maybe even finding opportunities that others might overlook?
That's a fantastic question.
Yeah.
And it really speaks to the heart of what it means to be an informed investor. While concentration does present certain risks, it also creates a unique set of dynamics that savvy investors can potentially leverage to their advantage.
Okay. I'm officially intrigued.
Yeah.
Give me an example.
Sure.
How could someone actually capitalize on market concentration?
Well, one approach could be to focus on identifying and investing in companies that are well-positioned to benefit from the trends driving concentration in their respective industries. These could be companies that provide critical infrastructure services or technologies that the dominant players rely on.
So it's like finding the picks and shovels during a gold rush.
Exactly.
You're not necessarily betting on which gold miner will strike it rich, but rather on the companies providing the essential tools that all the miners need to succeed.
Exactly. These companies might not be the flashiest or most well-known names, but their growth can be closely tied to the success of the larger players. Another potential strategy could be to focus on areas where concentration is likely to create opportunities for disruption.
Disruption, explain.
Well, think about it. When a few companies control a large share of a market, it can create a sense of complacency. They might become less innovative, less responsive to customer needs, leaving an opening for smaller, more agile companies to come in and shake things up.
So it's about spotting the cracks in the foundation.
Yeah.
And betting on the companies that are building the bridges to a new future.
Precisely. It's about understanding the dynamics of power and innovation and positioning yourself to capitalize on the shifts that inevitably occur in any concentrated market.
This is giving me a whole new perspective on market concentration.
Good.
It's not just a risk to be avoided, but a force that can create unique opportunities for those who know how to read the signals.
Exactly. It's about being adaptable, being curious, and being willing to challenge conventional wisdom. And that, my friend, is the essence of being a true deep diver.
Couldn't have said it better myself.
Thanks.
So to all our listeners out there, keep exploring, keep questioning, and keep diving deep into the world of finance. Who knows what hidden treasures you might uncover?